Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Ramsey, there's no tie. You lost your tie.
Yeah, I came back from New York, so I don't need the uniform anymore.
All right, so we're back to sort of normal attire. Got a great guest once again. Okay, I'm Ramsey. You got a very good person on to talk about where the industry is headed. Do you want to introduce him?
Yeah, so we're joined today by Dave Levenson, who's president and CEO of LIMRA LOMA, and he's an old friend of yours too, Paul. So
yes,
happy to share credit for bringing him on the show. Dave is a unique individual in a lot of ways. He was at Hartford for many years, at Edward Jones, and now running LIMRA LOMA. So the different elements of the industry that he has covered is broad and unique, and we're really delighted to have him join us today. So, Dave, welcome. Let's get started. Would definitely like to hear more about your journey. You've covered so many different areas, and then now you're back at Hartford focusing on LIMRA LOMA. Tell us about that trip.
Yeah, would love to. First, Ramsey, Paul, thanks for having me, and it is great spending some time with you guys again. It's been a little bit of time, but it is good seeing you in a more casual environment. So again, thanks for the opportunity to be with you today. So look, it's been a fun journey. So I was with Hartford for 17 years and did a lot of fun and interesting things. It is the annuity show, so I was managing the domestic U.S. business in addition to some other responsibilities, and then I had the opportunity to go out to Japan, which was a tremendous amount of fun for me, and just incredibly interesting. So Hartford entered, and I'm going to diverge a little bit, but just to give listeners a background, but Hartford entered the Japanese insurance business, which was really an annuity business, in 1999-2000, and shot up like a rocket. And within 5 years, the company was doing more business in Japan than it was in the U.S. And in the U.S., it was number one in market share, so just pretty incredible. But
Wow.
Then it kind of went down as fast as it went up. And I was sent out there to try to stabilize things for a little bit. So, I went out, spent 3 years there, and it was just a tremendous learning experience. We did a lot of great things, but, ultimately came back after 3 years, and, Hartford went through a lot during the 2008, 2009 crisis. And then, I got to run the life company. So life annuities, retirement plans, that was a lot of fun for me as well. In 2012, Hartford decided to get out of the life business and really focus on P&C. And at that point, Ramsey, I needed another job. So most of my time was focused on helping our employees land. But a fortuitous meeting with Edward Jones led to my next adventure. And I spent 6 years in St. Louis, ultimately leading their product suite in North America for everything that they did. So advisory platforms, mutual funds, insurance, annuities, etc. And that was great. And then this opportunity came along around 3 years ago. And, at this point in my career, the ability to give back to the industry was just compelling. The ability to get back to the East Coast to family was compelling. And here we are.
Well, hey, listen, fascinating journey, and I think it feels a long time ago, but not that far along, when we were having dinner in downtown Hartford, and you were talking to me about, I think at that point, Dave, you maybe had been on the job, maybe, I don't know, maybe 6 months, and yeah. I know you were doing a huge, review to say, okay, hey, listen, LIMRA's come a long ways. World's changing. How do you keep an industry association relevant? And you'd really undertaken a bold strategy to reposition the organization. Now, this was pre-COVID.
Yeah,
so
exactly.
Tell us, what happened? COVID hit. What had happened? How did this strategy prove out? How did you have to change? Talk to us about the whole COVID experience here.
Yeah, again, another incredible adventure, Paul. And you've got a good memory. I joined the association in 2019. January 2019, I took over as CEO. And, we laid out what we call our Compass 2025. So, where were we going over the next 5 or 6 years? And, what did we really want to do with the association? How could we benefit members? All the stuff you would end up doing in a strategic plan. And, that's still our North Star. And in some ways, in many ways, the pandemic, which hit just, 15 months later, accelerated a lot of things. I mean, some things we had to slow down on, but some things we truly accelerated on. I'll give you an example. One of the things that we said in our plan is we've got to do a better job connecting with C-suite executives. So a lot of the C-suite has known us, but not everyone in the C-suite knew us well. And yet we have a lot of wonderful research that, most people in the C-suite should be looking at fairly often. So what we did early in the pandemic is we have about 120 committees, study groups, that type of stuff. But we didn't have a lot for the C-suite, so we created what we called our CXO committees. So we brought together CFOs and chief investment officers and chief human resource officers and chief underwriters and chief actuaries. And the demand for executives to talk to one another. Nobody's been through this pandemic, right? To talk to one another and say, what are you experiencing? And, what are best practices? And how are you getting through this? And how are you getting through that? It was really a unique time, and it enabled us as an industry trade to really host some wonderful meetings that helped our member companies kind of get through a pretty tough time. There were other things that we were able to do that I thought were incredibly valuable. So, go back to 2020, the markets were pretty crazy, right, for the first couple of months. But you remember how low interest rates were.
Yeah.
Right? And we had just taken on a project at the request of some of our board members to really study low interest rates and the long-term impact on the industry. So we brought together Oliver Wyman and the ACLI, and the three organizations worked with over 100 executives to put out a lot of great insights and research about how to get through this low interest rate environment. So again, in many ways, the pandemic has helped us. But let's be honest. I mean, just working remotely and going through a lot of change has also been a little difficult.
Are there any key takeaways, sort of big picture takeaways from that study? I mean, that's clearly right. It's an industry that lives and breathes on yield. So I'm just curious what were some of the key conclusions there?
Well, I appreciate that question, Ramsey. From a regulatory perspective, I would say, the regulators weren't really ready for this, right? What happens if interest rates go negative? And, when the 10 years at 1.7, nobody really thinks about that. Maybe they do more so than when they were at 3 or 4.
Yeah.
But when they're at 40 or 50 basis points, it becomes a little bit of a different focal point for the industry. So, I think we got our members to really think about negative rates and the impact of negative rates, and we got our members to really think through, what happens if this doesn't turn quickly, from a capital management perspective, from a sales perspective, from a product value perspective. There's so many different perspectives. So I think ultimately, Ramsey, there were a lot of really interesting takeaways. I remember having 6 subgroups, and each subgroup focusing on a different dimension. And then we had a wrap-up presentation at the end of 2020. But here we are, just a couple of years later, and now we're worried about wage inflation and inflation in general. And will interest rates pop too quickly, as opposed to are we in a 50 basis point scenario again? So it's interesting how quickly the world changes.
So, just following up a little bit on that, you talked about your experiences in Japan, and so things like negative interest rates are something that, you you probably saw, or at least on the horizon, in Japan, not just low and negative, but over a long period of time. Just very curious about how your experience outside the U.S. in the insurance industry, which is unusual. We can be a very domestic industry if you think about it. Like, how that is informed, your thoughts on the industry and frankly, your broader goals for LIMRA LOMA.
Yeah, look, the world's a big world. And I think one of the key lessons for me going through the pandemic was, one of the groups that I mentioned, there were 6 groups looking at these low interest rate. One of the groups looked at just, what was going on in different parts of the world. So what happened in Japan, what happened in, Switzerland, because some of those countries, were in a negative rate environment. And of course, in Japan, they've been in a low interest rate environment for an awfully long time. So the ability to kind of look into, how are those industries working? What are their concerns, challenges? I think those were some pictures that we were able to really help members with. But look, there's a lot of different factors at play. So I'll give you an example of the product that launched Hartford in Japan and really got us to this amazing position. So it was a 10-year annuity with a payout over 15 years, right? If you had below your if the account value were below principal. So think about it as a GMIB, a 25-year product, and all we did was guarantee you'd get your money back over that 25-year period, right? And this is about low interest rates.
Yeah.
So that doesn't sound like much of a guarantee, right?
Yeah.
But it enabled Hartford to go from nowhere to more sales than what it was doing in the United States, which was pretty incredible.
Sure.
But just to finish that story in Japan, what happened is a lot of the domestic players were watching this, saying, "Oh my God, here's this U.S. company coming into Japan and taking this massive market share, and we can do better than that, right?" So it became like an arms race. Yeah. And pretty soon, people were doing 10-year GMABs in a low interest rate environment. And we were looking at it saying, we went to your former company and said, how much would it cost to hedge this? And the hedge was 50% more than the price of the product, right?
Yeah.
So it just became a really crazy environment and just shows you how much you really need to understand. It's not just about the sales, as you know. This is a big risk management play. But putting those pieces together was so fascinating. Again, to watch our rise and then to watch how the whole industry adjusted.
Yeah, we've had a couple of companies on Ramsey over the last 6 months focused on just flat out optimizing interest rates, safe interest rates.
Yeah.
It's interesting, Dave. Both of them have had very little to do with insurance and annuities, but I think they will end up leveraging annuities at some point. Yeah. Now, with inflation rates, again, whole new ball game. Maybe talk to us about. Maybe we could shift to one other sort of big underlying theme: pre-pandemic, during pandemic, post-pandemic is going digital, right? I think before the pandemic, it was kind of innovation, thinking about the future. Felt like the middle of the pandemic was we just have to do it in order to even do business. Where's the puck headed on digitization of insurance carriers?
Yeah, look, I think the industry made a lot of progress in the last couple of years because it had to, right? So, on the life side, we saw just a big jump in things like accelerated underwriting. We saw a big jump in terms of the digitalization tools or the digital tools that advisors need to interface with clients. And we saw tremendous productivity gains, right? So all of that, I think, was very positive. We saw changes in, things like e-signatures and just again, those are all positive things for our industry. So it is going to continue. And I'm bullish that some of the changes that I think were long overdue have been made, but there's still a ways to go for sure. One of the things that I think was really good for our industry is with life insurance, we saw just tremendous demand, right? And that's not a surprise in the middle of a pandemic. So, we saw sales at levels that we hadn't seen since 1983. And even the annuity business, which really surprising to me, has been flat. Like if you take the pandemic years out, it's been flat for the last decade. But we saw that that business jump 16% in aggregate. If you just look at 21 versus 20, and 20 was up versus 19 toward the end of the year from a run rate perspective. So I do think the pandemic's been good to the industry when it could have been really bad. But to your point about digital, there are some things that we did that are great, and there's a lot that we have to still do.
Now, that's interesting. You mentioned the life insurance sales, and I've heard that. I mean, if the companies I saw, Dave, who had, they had e-signature, they had e-app, they could do direct sales to consumers, they could do rapid underwriting. They had banner years. I've talked to some of my peers around the market. Do you think the spike was effectively an acceleration of purchases of insurance, or do you think it's somehow sort of changed the demand going forward, just in the life insurance sector?
Yeah, so that's the $64,000 question. I'll say that we know that the demand increased. So we did a study in the fall of 2000, and we know that because of the pandemic, demand for life insurance increased about 31%. So similar to the study that we did on low interest rates with Oliver Wyman and ACLI, what we did when we saw that, Paul, because we want to be much more action-oriented, is we brought all of the life trade associations together. So back to ACLI, FinSECA, NALBA, NAIFA, MDRT, LIMRA, which is the Trade Association for Direct Writers. Life Happens. All of us got together and said, this is the time to unify. And we came together and we worked with 76 of our member companies, manufacturers and distributors. And Kate Thoreau on our PR side every week sent out a kit to all of these companies about what you need to know. And they were fact sheets. It was social media. It went out to the distribution organizations. And, it was our feeling that everybody became much more aware of their mortality, right, in the midst of the pandemic. And not only was it important for our industry to support customers, but we also felt like it was our responsibility as we heard all of these, horrific stories. So, I really think this was a good time for our industry to step up, and it was just, I'm so proud of how the insurance industry did step up.
So, in terms of your vision for LIMRA LOMA, I remember we were speaking, I think a few weeks ago, and you've got grand plans. So share some of those with us. I mean, you're obviously doing a lot of things here in the U.S. It's interesting because there's existing organizations that are already trade organizations, but you're playing a unifying role even among the organizations here in the U.S. And you're taking steps to expand outside the U.S. Tell us about what your vision is there.
Yeah, Ramsey, I appreciate the question. So, look, when I came in, LIMRA's been around for 106 years. It's such a wonderful organization, and so it's got rich pedigree and strong reach and size. Right, it's the largest association in the world supporting life, annuity, and workplace benefits. So there was a lot of great things that had been done historically with the association. But let's face it, our industry was changing and has been changing very, very quickly. So I think it's our responsibility to get ahead of it and help guide our member companies through a lot of this type of stuff. So one of the first things that we did as part of our strategic review is we kind of stepped back and said, look, why do we exist? Why are we here? And what would happen if we weren't here? So that enabled us to step back and, something as basic as developing a purpose statement, right? And we developed a purpose statement that said, why are we here? And we're here to advance the financial services industry by empowering our members with knowledge, insights, connections, and solutions. So that purpose statement allowed us to be very, very focused on the things that we should do and the things that we shouldn't do. So when I think about things like knowledge, I think about professional development. And we have a designation program, FLMI, which is one of the largest in the world. And over 100,000 people have taken the FLMI designation. But our designation, this is probably 150 hours to get your full designation. Is that where the world is going, or do people want more quick hits? So we're shifting a little bit more toward foundational education. We're shifting to executive development work, but that's not something that we should do. It's something that we can partner with a Wharton to do. And in fact, in the summer, it's going to be our first program for Wharton executive education with LIMRA. And we only had 100 seats because that's all Wharton would give us. And here we are in March and we're sold out, right? We've got 54 companies that have signed up for this. And you go to Wharton, you go to the Wharton School 1 week a year for 3 years. And, you're taught by some of the best professors in the world about how to work through this change and navigate this change and, the peer group you meet, et cetera, et cetera. So, I'm going down a little bit of a rabbit hole, but what I'm trying to do is give you a sense that we're looking at our knowledge bucket. We're looking at our insights bucket. We're looking at our solutions bucket. We're looking at our connections bucket. And we're saying, what does that need to look like in 3 years for us to be truly indispensable to our members? And we have a full-fledged plan as far as what we're going to do this year, next year, the year after, to enable us to get to that point of indispensability with the vast majority of our members. So again, I could go on and on about different examples and different things we've done.
I've got two questions. First one was, so after 3 years, one week a month, you said, do you come out with an MBA, or what is?
Yeah.
Well, that'd be a 3-week MBA, right? No, you come out with a certificate, and candidly, we modeled this after a program that already existed.
Got it. Okay.
It's called SII, and it's between SIFMA, the securities industry, and Wharton.
Got it.
And whenever I went out and I talked to our member companies, they had no idea what I was talking about when I brought up that program. And I said, I went through it when I was with Edward Jones. It was a phenomenal program.
Yeah.
Why shouldn't our industry have the same thing? So that's essentially what we did. And the people on our team that put this together are just doing an exceptional job. And I'm super excited about what it's going to look like in July.
Got it. And the second thing was, you said you were talking about things you should do and shouldn't do. So I can't resist.
Right.
What were the things what were the things you thought that maybe you could de-emphasize if it's not controversial?
Yeah, I'm not sure I want to go into a ton of detail about that type of stuff, but what I'll share with you is, we are an industry association, which means if we're not going deep with our solutions with 15, 20, 50 companies, there's probably limited value in what we do. Mm-hmm. So we had a lot of solutions that 3 companies picked up or 2 companies picked up, and candidly, we've done away with several of those.
Got it. All right.
Yeah.
Very helpful.
Yeah, absolutely. Now, we also do have a lot of agents who are listening, and I know agents. I'm trying to think. If I'm an agent, I know LIMRA from, taking
AML.
my. I'm sorry, AML.
AML.
Taking my licensing, or taking my mandatory training. There's a lot of stuff I probably don't know. How does your industry touch me as an agent?
Yeah. So when I think about, and I'll give you I'll go a little deeper now. So I gave you a little bit of a vision for knowledge. I'll give you a little bit of a vision for insights. All right. So when you think about insights, think about our research organization, which is the heart of who we are and who we've been. We've got about 30% of our organization that's focused on the research function, 30% of our 320 people. So when I think about where we are very focused, again, we used to do a lot of stuff. Just the breadth of what we did was incredible, and this might get back into what did we stop doing. And now what we're saying is we are very focused on three verticals: life insurance, annuities, and workplace benefits. And there are three functions that we are very focused on, because we could go all over the place with life, annuity, and workplace benefits. But from a research perspective, we are focused on distribution, and we are focused on the customer and customer insights, and we are focused on product. Those are the three. So when you think about, Paul, your question, we are going to be doing a lot of research in that we call it our 3x3. So annuity distribution is one of those boxes. And, we will be able to provide a lot of research to, our members that manufacture products and our members that distribute products about annuity distribution. So what do advisors want, and what do customers want, and how do advisors meet those needs? And we've got a ton of research already that we've done around these things, but we're going to get even more focused around it.
Got it. Again, from the agent perspective, and I'll stick to our area, annuities. Yeah. We talked about life insurance. Lots of change. I think about my career, Dave. I started with a mutual. It turned into a public company. Worked for a private equity-owned insurance company when I think it was, we were one of the first few. Now it seems to be, private equity ownership is almost the
becoming the norm.
It is the norm. But lots of change. You got PE firms coming in, but then you see a lot of companies, boxing up their annuity business and giving it to people to run as closed blocks. How do I make sense of this as an agent? Do I need to worry about it? Is this just sort of a normal changing of the guard in an industry, and whose bank account is backing the products?
And again, you're asking all the right questions, and I wish I had a crystal ball to tell you kind of what it all means. But what it does mean is that, again, there's a lot of change, right? So the industry just in the last 24 months has changed tremendously. With the amount of private equity firms that are in place. And, people always say, Dave, is that good or is that bad? And I say, look, I don't know if it is good or I don't know if it is bad. It just is, right? And that's our reality. So, when I think about, and again, Edward Jones had 18,000 financial advisors. When I think about the role of the financial advisor, they've got to make sure that the products and solutions that they bring to customers meet their needs and are good for the time period that the customer wants them to be good for, right? So if I'm 55 and I want to turn income on at 65, I need a product that's going to be around for 20, 30, 40 years. I think with the help of insurance regulators, there's a lot of products that are in force that are still good products, and whether they're owned by, Blackstone or whether they're owned by a traditional mutual company, I'm not sure it matters that much. I think there's a lot of solvency for the companies that are backing those products. As it has implications to new products, right, and what advisors or agents could get excited about, I think it's going to open up more creativity and innovation in our space. Anytime you have new entrants, that's what they do, right? To disrupt, I've got to come up with different solutions, different ways of doing business. I'm a big believer that that is never a bad thing. So it's good for customers, and ultimately, I think it's good for our industry. So those that get in front of the change and those that can leverage the change effectively are going to win, I think, over the next several years.
So now you brought up, pardon me, you brought up as one of your three key areas, workplace benefits. And
Yeah.
the Secure Act is something we've talked about on this show a lot, and it's something I spend a lot of time thinking about in terms of my own business objectives. Very interested to hear what sort of thoughts have been developed within LIMRA LOMA vis-a-vis in-plan annuities that and other initiatives that are sort of essentially born of the Secure Act. Would love to get your perspective as somebody, one who's sort of in the middle of the industry, United Nations, if you will, and how many years do you think it's going to take before it really finds its momentum?
Yeah. So Ramsey, you probably know more about this than I do. But what I'd share with you is, the Secure Act, good thing, right? A good thing that it requires an annuity solution on a lot of these plans. But early on, again, if I'm a provider of the industry, if I'm a 401k provider, I kind of look at this and say, MEPs, PEPs, good, bad, growing fast. I mean, so the fact that we can get in front of this, because we're so good with benchmarking. I mean, it's kind of when I talk about research, the heart of our research is our benchmarking. So people will look to us and say, all right, I've been watching, but is this happening? What's happened the first couple months? And we provide those insights to our members, which is super helpful. Similar for in-plan annuities. And, you know as well as I do that the take on that has been slow. Yeah. So there are a number of plans that are offering these solutions. But at the participant level, it's still fairly complicated. So when you ask the question, how long will it take? I think about this and I say, are in-plan annuities the right thing or the wrong thing, right? And I say for a retirement plan, they're absolutely the right thing because we are getting tax preferred treatment on retirement plans because the government wants us to help people in retirement, right? Yep. And the best way to help people in retirement is to ensure that people have income while they're in retirement. At the end of the day, that's what the government is supporting us to do. That's what we should do. So I'm a big believer in in-plan annuities. It's a very sophisticated solution relative to what people are used to. Maybe it's not super sophisticated. It's just different, right? But when I think about, back to your question, Paul, about digital and the role of, I think that's all going to come together nicely. And I am bullish that we're going to see growth in that space, but I don't think it's going to be at, at a level of speed that, over the next 2 or 3 years is going to, break any speed records.
Got it. So I have,
but it's coming.
One more question that really sort of harks back to your time at Edward Jones. So you were working for one of the premier sort of financial advisory firms in the United States, and you were coming in there as an insurance expert. One of the tensions in the industry is how we engage with financial advisors effectively, right? So meeting them where they are in terms of the kind of products they like, compensation structure, et cetera. Any insights you can share from that experience would be fascinating.
Yeah, look, Edward Jones is an exceptional firm, as are a lot of the other firms out there that a lot of your listeners work for. But one of the things that I respected greatly about the organization is that its focus on the consumer, and ensuring that whatever we did was right by the customer. And we had checks and balances all through the organization to ensure that that was always true. So, Ramsey, what I'll do is I'll draw a little analogy here, right? Because this is the way I always used to think about things. So, think about how much time and effort the industry is spending on fiduciary and the DOL rule and the SEC rule and the syncing up of the rules and where's it going, and and then think about the core of what it's designed to do. Right? At the end of the day, it's really designed to protect consumers, right? To ensure that whatever somebody sells them is right for them, right? And then think about, if you step back and think about how many consumers sit down with an advisor and truly get a broad-based plan that addresses all of their needs, right? And insurance, retirement income, investments, college planning, that all has to factor in together. So the way I looked at it is that is the gold standard. That's what every advisor should be doing. And look, I know life insurance can be very clunky, right? Sometimes you have to fill out an application and maybe it's more paper intensive than it should be. But is it necessary for a 40-year-old with a young family to have life insurance? And if I'm an advisor, is that my responsibility? Right? Back to, again, the concept of fiduciary. So in my heart, right, and I think in your hearts, and I think in most advisors' hearts, that is absolutely what they should be doing. And they can point to insurance and say it's clunky, or they can point to annuities and say the technology is not where it needs to be and things aren't integrated. But we as financial professionals need to go that extra mile and ensure that it's all coming together the right way, even if it's extra work, because our responsibility is to make sure that consumers are invested and have protection where they should.
Wow, that's great.
Absolutely.
It is. Now we're almost at the top of our time. So Dave, I've got the big why question. So
yeah,
you've got a huge board of, I'm sure probably if you have 20 members on your board, I bet you got 20 strong opinion,
yeah.
Right?
Yeah.
You've got a very complicated organization, a lot of different set of very important services that you deliver to the industry. Why do you do this? Why?
Why do I do it?
Yeah, why do you?
So, Paul, I think this is a little bit of a higher calling for me, right? I love what our industry does. I think it serves an incredible purpose. So whether it's life insurance or annuities or even investments, long-term care, group life, group disability, they are wonderful solutions for so many people in our country and so many people in the world. And if I can just take this last leg of my career and help more companies deliver those solutions effectively to consumers, then I think there's more value I do in this role than working at any one company trying to influence what that one company does. So, it's a privilege to work with a trade association, much more so than I could ever have imagined. And, I've got a large board, but it's not a corporate board, right? A corporate board with 25 people would be a circus. I've got a member board of 25 people, and they provide me guidance and advice and stewardship, but they're also the consumers of what we do. And that's one of the key reasons that we have 25 people. But I've got to tell you, I work with some of the best people every day, whether it's these leaders of our member companies or whether it's the employees that I'm privileged to lead every day. And it's been a thrill. That's why I do it, Paul.
Thank you. Yeah, and Thank you, Dave. I think what you're doing is tremendous. I mean, LIMRA really has had a huge impact in the past. I think where you're headed and what you've done, over the last couple of years has been phenomenal. And I can't wait to see what the next chapter is. So
yeah, it'll be fun. Before you guys cut me off, I do want to. I promised Ramsey. This just gives you a sense for some of our annuity research, because there's some fun stuff coming. So annuity income by race and ethnicity. This report is coming out real soon from us. The upside and the downside of annuity product selection. That is already out. Annuities, what do advisors think? That research is already out. A reference guide, which is like a 200-page book about the retail retirement reference guide, the 5th edition. We've got a forecast, a future view of annuity sales. We didn't even talk about RILAs and FIAs, and so people should certainly tune in for that. And gosh, we've got a lot of convening opportunities with our conferences and our committees. And if any of the listeners would like to have more information about this, just contact me or anybody at LIMRA.
That's great.
So how do people get that data? Obviously, members get that data. If you're an agent or an agency, do you subscribe? How will they get exposure to all that great information?
Yeah, again, we're a member-based organization, so most of the stuff we do is for our membership, but our membership is not unique to the carriers anymore. So distribution firms, almost all of the large broker-dealers are members. A lot of the large insurance BGAs are members. We're always looking for more members. And then, we share some of these things, obviously, with other trade associations, whether it's FinSECA as an example on the life insurance side, or IRI as an example on the annuity side. So we're all big on sharing if it helps make the industry a lot stronger.
Fantastic.
Excellent. Hey, Dave, thanks so much for spending some time with us. And Ramsey, anything else on your end?
I'm excited to see what the future holds. I'm really excited to see what Dave has in mind to grow LIMRA LOMA's influence, outside the U.S. internationally. So I'm watching with great interest.
Excellent.
I'd love to come back and tell you about our international plans. It's pretty exciting.
Oh, great. Okay, you're on.
Be careful what you wish for.
We'll write this down. Look out, Dave. All right. Listen, thanks so much. And hey, thanks to all our listeners. Join us again next week for another episode of That Annuity Show. Thanks.
Great seeing you guys, and thanks for doing this.